certainly what it means for the U.S. economy in particular. S&P 500, by the way, folks, it is set for its worst day in 2025. We are seeing bonds move up, as I mentioned, down more than 700 points on the Dow Jones Industrial Average, about 486 to the downside of the NASDAQ 100. We're coming off our lows of the session, so we were down a little bit more before. But what is interesting is what we've seen on that ISM data and that manufacturing data. We've seen yields lower today, but we've really seen a move down along the U.S. Treasury curve.
Hey, in the S&P 500, Carol, not everything is in the red. Real estate, consumer staples, healthcare, and utilities are in the green today.
And that's better than it was. There was only 2 groups in the green just about 15, 20 minutes ago. So we have seen, like we said, come off our lows. Do not go anywhere. We're heading over to our TV colleagues. The closing bell starting right now.
Continue.
Right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Steele taking you through that closing bell. A global simulcast starts right now. Scarlett Fu in the TV studio. Carol Massar, Tim Stenovec in the radio booth as we welcome our audiences across all of our Bloomberg platforms to parse the most crucial moments of the day. And Carol, it's been quite a few. The vibes really off. I don't know if it's because of the economic data, if it's because of the tariff discussions, or maybe just everything in between.
I would say yes, yes, and yes. And I think what's really interesting, yes, obviously what we're seeing in the equity trade, but you look at what's going on with the U.S. Treasury curve. I mean, to see what 393 on the 2-year note, lower on the 10-year, just all along the curve, Scarlett. We were just talking with our Enda Curran, who watches the global economy, and slowly we're starting to hear maybe more people talk or say the R word, recession. Maybe he said not yet, there yet. But just interesting to see kind of a change in tone today.
Yeah, maybe the ISM manufacturing number that came out this morning kind of gave us a hint of what was to come, right? Employment and new orders contracting, and the growth in manufacturing slowing down, almost stalling. That kind of looks like stagflation.
Look what's happening to semiconductors today. On a day when we hear this announcement from TSMC and President Trump, you got NVIDIA down 8.7%, you got Broadcom down 6.3%, the stocks as a whole down 4%.
But to be fair, we also had the chips down, particularly NVIDIA earlier, unrelated to any of this, as you have certain entities looking into the fact whether Supermicro, for example, had NVIDIA chips, and that made its way into China. So there was already something separate that was weighing down on that chip sector.
Yeah, absolutely here. But again, no real sector spared today. A few bright spots out there, but they are middling to be sure. The good news is we are off the lows of the day by a big amount. The bad news, all of those gains that we saw in that dip buying rally on Friday have effectively been erased. The Dow Jones Industrial Average lower by more than 600 points, or 1.5% on the day. The S&P lower by about 100 points, or 1.8%. The NASDAQ Composite down 2.6% on the day. The NASDAQ 100 down 2.2%. But here's your big lagger. You're going to find that in the small and mid-cap space. S&P 400 mid-caps down 2.2%, and the Russell 2000, the small caps, down 2.8%.
Yep, go back to the big caps, if I may. And you're right, we are definitely off our lows, Romaine, of the session. It was looking a little bit more dire about 15, 20 minutes ago. Having said that, look inside the S&P 500, 335 names to the downside, Scarlett, 166 to the upside.
All right, let's take a look at the IMAP, which looks at the S&P 500 based on the 11 industry groups. And no surprise here, tech, the leading decliner, off by 3.5%, matched only by energy, also down 3.5%. Consumer discretionary, which includes Tesla and Amazon, down by 2.3%. The outperformers here are the little slices of green that you see there. REITs, staples, healthcare, utilities, classic defensive sectors.
All right, and so I thought I had 3 gainers, but it turns out now I only have 2 gainers.
That's what happens on a day like today. You know?
All right, let's go to Capri Holdings. That one, first of all, certainly has been an outperformer in today's session. It's up about just shy of 4%. It was up as much as 9% earlier in the session, but finishing the day with about a 3.9% gain. This is said, as Prada is said to be moving closer to a deal to buy Capri's Italian luxe brand. You may know it as Versace, after agreeing to a price of nearly $1.6 billion. So,
what's it called?
Versace.
Oh.
Versace. Did I say it wrong? Versace.
It's
I'm
fine.
American. I say Versace.
Me too.
Versace.
That's okay. Carol's fancy.
All right. Versace. All right, let's go to Allegro. I knew, as soon as it came out of my mouth, I'm like, didn't come out right. Allegro Microsystems. Let's hopefully get that one better. Up as much as 22% today, finishing with a gain of about 15%. It's a semi-manufacturing device company said to be drawing takeover interest from larger competitor on semiconductor, according to folks in the know. And it might be that some companies are interested in bulking up their automotive capabilities by looking to buy this company. But that was definitely an outperformer. And then Palantir, well, I don't have to do it because it actually turned into the red.
All right. Well, I'll add another honorable mention here. This is in the after-hours trade. Okta shares up about 8% here after fourth quarter EPS came in slightly above street estimates, 78 cents a share. The street was looking for 74. Revenue also came in slightly above street estimates at $682 million. Here's your forecast for the full year of fiscal 2026. The company sees adjusted EPS in the range of $3.15 to $3.20 a share. The street on average was looking for $2.92, so even the low end of that range well above what the street was looking for. A similar story when it comes to their revenue guidance, $2.85 billion to $2.86 billion. Street was looking for 2.8 even.
All right, a bright spot. We'll see if it holds for tomorrow's session and certainly after the call. I do want to get to some of the laggards in today's session, starting with shares of NVIDIA falling 8.8%. It's the worst performer in the Mag 7 today, the biggest drag too on the S&P 500 and the NASDAQ 100 by a long shot. Alex mentioned this. Singapore investigating whether Dell and Supermicro servers shipped to Malaysia contained NVIDIA chips barred from China, highlighting the role of middlemen in funneling high-end semiconductors. The risk-off sentiment that developed throughout the session today, not helping NVIDIA at all either. It's actually at its lowest level going all the way back to September and down just about 25% roughly from those highs back in January. And Sonova Energy falling today by 64%. It's the solar energy company. Shares tanked after they said there's substantial doubt regarding its ability to continue as a going concern for a period of at least 1 year from the date that it issues its consolidated financial statements. The company also removed its guidance, according to a presentation. And ADRs of TSMC, Taiwan Semiconductor, down today by 4%. Just keep an eye on those shares after the company announced that it plans to invest an additional $100 billion in U.S. plans to boost chip output on American soil and support President Trump's goal of increasing domestic manufacturing.
All right, where do you go in a market like this? You go to the safety of the bond market, bid all across the curve. Taking a look at that back end, the 10-year yield falling to 4.16%, a really strong move here. Ira Jersey of Bloomberg Intelligence, he heads up U.S. strategy there, says that 413 is a pivotal point that could shake out a lot of other investors. So if you break that level, maybe a lot more buying to come. So just kind of watch that space. But overall, you have to see, guys, I have to say, wouldn't you have expected the bond market to be down like 10 basis points, 12 basis points on this?
Yeah, I mean, I thought it was interesting, too. I mean, you did see a little bit of a bid come into other safe haven assets,
True.
but it gets to this idea here of where is there to hide right now, because at the same time, you talk about the safety of bonds, Alex, but you're still dealing with other issues that could actually affect the valuation of that, such as our budget issues and other things that aren't directly related to trade or tariffs. So it does kind of become, I don't know what the euphemism is, whack-a-mole or whatever, where you're sort of looking for somewhere to hide, and then you pop up and realize that, oh, here's another policy thing that's going to just kind of set the knees.
Until today, people might have said crypto as of yesterday with that announcement of the strategic crypto reserve coming from the president, but there's a lot of skepticism and questions around what that actually looks like.
Did Tim just ignore my quip?
No, I didn't hear what it said. I would never ignore you. Please repeat it.
Another area of safe haven has been European stocks. The stock 600 closing at a record high, up 2%. You also see European defense companies. They've been on a rally all month, and that continues because now you have London and Paris talking up about increasing their military spending. The Swedish krona in particular has proven to be a safe haven as well. Big moves on that currency because that country's defense industry is seen benefiting from more spending.
Yeah, not about U.S. exceptionalism, but maybe European exceptionalism, at least at this point. Hey, I will say one other place to hide was gold today. It was up about 1.9%. So, certainly a safe haven play, or if you're worried about what's going on in terms of the economy or inflation, I don't know if that's the case today based on the economic data, but nonetheless, you did see some movement into that.
GitLab, those prices, that company is out with earnings, and application software company. Just taking a look here real quick at revenue actually beats estimates for the fourth quarter. Taking a look at its fiscal year, though, for 2026, their revenue could come in anywhere from $936 million to $942 million. That's missing estimates. Also taking a look at adjusted earnings per share. On the high end, they see 72 cents. The estimate was for 82 cents for the year.
Yeah, I do want to go back to also just kind of the tariff threat, if you will, the idea that all this is going to come down the pipe. Trump, of course, in that statement with standing alongside the TSMC CEO, which was ostensibly about investment here in America, basically saying that the time for negotiation is over. Now we're getting word from Canada, a story crossing the wire saying they've already prepared a sweeping package of counter tariffs. And that's a big part of this. We kind of forget it's not just about the tariffs we impose and what that means for the folks trying to import goods, but also the retaliatory tariffs and how that affects the companies that are making stuff here, but of course want to export them across the border or across the world.
We had an interesting chat with Keith Naughton specifically about autos and the way that auto prices could be affected. Some analysts saying that some auto prices could go up by $10,000, $12,000 per vehicle. And Keith kept mentioning the idea that these would be temporary tariffs. And that's how the automakers are thinking about it, because there is this off-ramp when it comes to border security that the president has given for Mexico and for Canada that doesn't necessarily exist with tariffs on China.
All right. We could certainly go on, but I'm sure we're going to have some of the similar conversation tomorrow. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you again. I know, Alex, you're heading out. Scarlett's continuing with Remain on TV, and Tim and I continuing right here on Business Week on Bloomberg Radio.
This is Bloomberg Business Week. Insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
All right, everybody, we're going to get into some more conversations about the market trade and the sell-off that we saw in today's session. Do want to mention, though, another earnings out after the close. B. Riley, the institutional brokerage, yeah, it's up about 11% here in the aftermarket. It has been. And the company preliminary fourth quarter EPS of $1.57 to $2.22, just starting to get some headlines, it looks like. So they're releasing the estimates of an unaudited fourth quarter 2024 financials.
Don't worry, Carol, my microphone is on now. Okay, I turned it on. My comment was they have been getting beat up.
They have been getting beat up. You did. Stocks up about 17% so far here in 2025. But yeah, we are seeing at least some movement in the after hours. So we'll keep a watch on it and continue to watch it into, no doubt about it, the Tuesday trade. It's going to be a lot on our plate tomorrow.
Down 90% from 2021.
Yeah, that's pretty ugly.
Yeah.
Yeah, okay. All right, so let's stay with the markets, folks, because we have seen some selling in today's session. We did finish off our lows. We have seen yields along the U.S. Treasury curve move down a bunch as well, Tim.
Yeah, that sense of caution prevailing as long-promised tariffs on top U.S. trading partners are scheduled to take effect on Tuesday. Meantime, we did hear from TSMC alongside President Trump planning to invest $100 billion in chip plants into the U.S. over the next 4 years. Jeff Krumpelman is Chief Investment Strategist and Head of Equities at Mariner Wealth Advisors. He joins us this afternoon, once again, from Cincinnati. A day like today, Jeff, down on the S&P 500, 1.8%, the NASDAQ, 2.6%. Are the clients calling?
Well, they're not, the phones aren't ringing off the hook, but I'm sure that they are, in a little bit of a worrisome mood, if you will, today. Our theme and thesis all year has been clear air turbulence. That's kind of what we talked about going into the year after being, very, very bullish the past couple years, and really expected, while we see the market advancing higher through the year, 10 to 15% pullbacks intermittently, and some air pockets that we're going to hit kind of through the year. And that's exactly what we're getting. And I don't think that we should be really surprised about that, given, what we've seen in the previous tariff rhetoric and announcements, what we saw over the weekend with regard to some of our, political partners throughout the world. So this is just what we're going to get. We need to buckle up, for this and be prepared.
Well, is this a buying opportunity then, or do you see further downside where people could start, picking stuff up at, I don't want to say a bargain given where valuations are right now, but is it a buying opportunity?
You know, I think it certainly could be a buying opportunity. I would be biased to be there, but our message still in this environment is hold your ground. And after 60% cumulative returns over the last 2 years, we suggested to folks, hey, that's probably taking your allocation well above normal. Cut back to normal going in, to the year. And, quite frankly, I would hover there. Now, having said that, we have a base case of about 6,600 on the S&P 500. And I don't think any of the news today changes that. And we do take our signals from earnings, rates, credit spreads, trends in inflation. And those are the things that are going to drive the market. And the mosaic is positive. So I would lean into what you're suggesting here in terms of this is an opportunity, I think, to add, particularly if you trimmed your allocation back to normal.
Having said that, it doesn't mean, Jeff, that we couldn't see some more selling.
Oh, no. I think our message kind of, look, we're 5% off the February 19th high. Mm-hmm. We're, just slightly off from, where we were December 1st, a couple days after the election. And as I said, we were looking for air pockets of 10 to 15% just on the psychiatry of all this. Whether it is tariffs, concern about federal debt, deportation, geopolitical discussions and whatnot, that moves the dial when you're at 22 times earnings and you've had growth stocks significantly outperform and trade at higher PE levels. You're going to get these moments. And so, yeah, I think we could go lower. I wouldn't rush in, but, I think you're going to get some price points where you're going to say, okay, a lot of the carnage has happened. And I also think, Carol, that you can do some tactical repositioning in here. We've seen a shift in leadership. And I think what you own and how you're positioned in here is important. We've made some adjustments to that and may make some more.
Meaning time to buy outside of the U.S.?
That's not a bad point. We are kind of domestically biased, but if you don't have exposure to international stocks, I certainly would be thinking about that this year in an active way. You don't need to do that passively. You can do it in an active manner, and certainly the international markets have outperformed so far U.S., but also within U.S. and from a sector standpoint, you saw extreme outperformance in the growth stocks. And the S&P 500 is really a concentrated index right now, with 7 stocks representing a third of the portfolio. The Russell 1000 Growth Index, those growth stocks represent 7 stocks, more than 50% of the portfolio. So yeah. I think you want exposure there, but not to the same level as the index. And healthcare looks good. And some of these defensive areas are leading this year. Well, we would take the foot off the pedal a little bit.
Hey, and that's what I want to ask you, Jeff, about some of the areas that you like. And that includes some in consumer discretionary. And one name that you shared with our producer, Paul Brennan, is Kroger. And that was in the news today. The CEO resigning following an investigation into his personal conduct, the company replacing him following this investigation, which was deemed inconsistent, their words, with the company's policy on business ethics. This is someone who has been in this industry, been in this company for a long time. What's your take on that news?
Well, Carol, I know about as much as you do right now at this moment. That was kind of breaking news. And, I think without learning further, they said it was a non-business nature. Mm-hmm. This apparently was personal conduct. It's a wonderful business model. If you look at the basic fundamentals with regard to same-store sales growth, trend in profit margins, their private label business, their digital marketing strategies, this is the type of stock that you want to own in an environment when people are freaking out.
And it doesn't matter. I mean, this is a guy who basically grew up in the company, go back to 1978 when he was a stock clerk. I've had an opportunity to talk to him and interview him. And I'm just, this is a business he knows so well. It doesn't matter to you in terms of an investment play if the CEO has changed?
I think they have a deep bench, and this wouldn't get me to actually rethink owning Kroger at this point. Certainly, I think, we want to know more, but I think they do have a deep bench and a wonderful business model. So I think many companies have gone through, management change like this at the highest level and have executed quite well on the other side of that. I see no reason to think that they cannot do that. But certainly it's a headwind here from a price action standpoint for, kind of the near term. But those are the types of stocks, whether it's Kroger or J&J or Amgen or Vertex or some of the other names that I gave you in kind of, the more staple area of consumer or healthcare that I think you want to look toward.
So it's not just Cincinnati bias about why you picked Kroger, company in the space there. Just making sure, Jeff, just making sure.
I didn't mention P&G, okay?
You didn't mention P&G. I was waiting for that one.
No, hey, I did not do that.
Always great when you join us. But, we like it more in the studio when you come and visit us here in New York. So hopefully you'll do that soon. A big thank you to Jeff Crumpelman, Chief Investment Strategist and Head of Equities at Mariner Wealth Advisors. Hey, we're taking a look at just the big picture today, Carol. It wasn't a pretty one, down 1.8% on the S&P, 2.6% to the downside on the NASDAQ composite. Caroline Levitt on Fox News saying that the president will speak about his economic agenda tomorrow evening.
He will indeed. If you look at the S&P 500, the NASDAQ 100, both oversold based on the RSI reading. This is Bloomberg.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. The S&P 500 index coming off of its worst sell-off of 2025. Lots of concerns for investors today. Tariffs among them, right to the numbers, with the S&P down 105. That was a drop of 1.8%. The Dow Industrials down 650 today, down 1.5%. NASDAQ was down 497, dropping 2.6%. The 10-year, 4.16%. The 2-year, 3.95%. Gold up $35 the ounce, $28.92, a gain there of 1.2%. West Texas Intermediate crude down 2%, $68.37 for a barrel of West Texas Intermediate crude. So bottom line here today, a down day for the Dow, the S&P, and NASDAQ. Stocks falling sharply, and this Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitment. Offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. 10-year yield again, 4.16%. The 2-year, 3.95%. Bitcoin, a major sell-off today. Bitcoin down 8.4%, 86,360. Again, recapping, stocks lower. S&P down 105, down 1.8%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Hey, Carol, some news in the world of real estate today. Apollo Global providing a $275 million loan to refi a pair of apartment towers in Manhattan's financial district. It's interesting because lenders, they've been active in financing luxury residential products in places such as Manhattan, South Florida.
Good market, strong market.
Yeah, demand for those areas remains high.
Yeah, they have been active. For some context on that demand, we bring back Louise Phillips Forbes, real estate broker at Brown Harris Stevens. She has sold close to $6 billion worth of real estate since she began back, was it in the 1990s?
1990s.
Still
1990.
It's a lot. It's a lot. It's a lot. Hey, nice to have you here back in our Bloomberg Interactive Broker studio. I just want to start with something that, you know, we are looking at a market that has had some nervousness in it today. We think it's pretty clear that there's concerns about tariffs out of the White House, what impact it will have on growth in the United States, just all of that. Tell me, coming into this, what do you want to tell me about what's going on in your world in terms of the market, the economy that I'm sure your clients talk to you about, the business backdrop, the economic backdrop? What are you hearing?
So I think there are a couple of things I would say. You know, everybody thinks that the real estate market is going to react in the same way, in the same time as the stock market, and that isn't necessarily the case. It does have cause and effects. I mean, you know, I just literally, on my way over here, I was like, how many deals do we have in contract right now? You know, over 10 million. It's 104.
Wow.
Ranging from 10 million and above up to 55.
This is just Manhattan?
Just Manhattan.
Sounds like a lot. Is it a lot?
It's a lot. I mean, listen.
Is that typical? Like, is that where we were?
It feels like that somebody's not reading the news. However, people have been waiting a very long time. And I will say in March of 2000, the market dropped 600 points for me. And I was, thank goodness, I went to contract and I put $600,000 into real estate. So I was thinking, what would that have been worth if I didn't pull it out? So, you know, there's a lot of things that affect our markets. You know, you can go from inventory to interest rate, COVID, policy. Policy has a big play. It doesn't necessarily affect it, immediately, but immigration and who's going to be in our workforce, that's going to be an immediate impact along with tariffs.
So talk a little bit about that. And now you're thinking about that as somebody who buys and sells real estate in New York City. I mean,
I can just speak about a small little minute example in my own portfolio of business. I did a renovation in 2019. It was 2,700 square feet. It cost us $430,000 to do this renovation. They have their own GC. It's a construction company who also owns
GC meaning general contractor?
General contractor, but they also own $3 billion worth of real estate, so they know what they're doing.
Right.
Fast forward, this past fall, we completed the same exact renovation for $815,000. I mean, that is
Is that a materials story or a labor story or yes and yes?
that is cause and effect of what we've all lived through globally, and
But what does that mean? So to Tim's point, is it because the contractors, I have two brothers who work in contractors, they talk about lack of workers. They talk about higher materials costs. Is that what it is?
Yes, I mean, it's part of that, but it's also everything. I mean, codes and the policies of getting construction done in your buildings, you know, since Surfside, you know, the policies for safety are much more
The building collapse in Florida.
and much more impacting what it costs for insurance. My own insurance in my own co-op went up twice, 38%.
Yeah.
So it's pushed in every angle. And then you have this kind of attitude, sort of politically, and policies that are going to have impact. And it's
And yet you have more than 100 contracts waiting to be signed
signed. These
for
are
deals
hard
of
deals.
10 million and above.
So it'll be interesting to see if any of those
Come out.
don't close.
Yeah.
Because they're concerned about this impact. But at that luxury price and that level, you're dealing with 1% of the 1% of 1%. It's not the everyday guy. It's not even the guy that's buying that renovation that I did for $830,000. They're thinking, shoo, that would be 1.4 for me.
Right.
So, but listen, we knew
Hence
it was
the
gonna,
market we talk about of the wealthy in kind of one class, right?
Yeah.
And then there's a lot of folks who moves, you know,
who are affected. I mean, they're listen, but
are having a tough time.
You start to see things that happen because of that cause and effect. If you think about, I was reading an article about generational wealth, and you know, I'm looking at 50% of the first-time buyer transactions that I've done in the last like 3 to 4 since COVID. I would say 50% of those are gifting or co-purchasing by parents. So, and they're referring to it as the silver tsunami. So,
Yeah.
it's interesting. And when you talk to your wealth advisors, they're like, listen, there's going to be $4 trillion generational.
Hey, it's Monday.
Yes, amen. I need another cup of coffee. But it's affecting that, and it's going to be passed down. And when you're also dealing with we have developers with the tariffs that are talking about putting in their contracts contingencies. And who's going to sign a contract when you're not sure what 25% mean? What does that mean? So it's going to remain to be interesting.
Andrew Cuomo jumping into the mayor's race. Does
I had a feeling you were going to go there.
Well, I'm just wondering, you know, we talk so much when we talk politics, we talk at the national level and out of Washington, D.C., but your world is so focused on New York City.
Sure. I mean,
does the who's mayor matter?
Who governor and mayor and how they work together matter, but those policies, you know, when you had Bloomberg for 12 years, he, you know, rezoned 41% of the landmass of Manhattan. It was tremendous growth and employment and, you know, areas that were not appreciating that have now become like, you know, great anchors for a whole area. We need strong leadership, no matter who it is. We need strong leadership. And it also has to be somebody who understands cause and effect and is interested in the growth and also the well-being of our quality of life.
Are you at all concerned about Governor Hochul going up against President Trump in the way that, you know, we saw with congestion pricing, Sean Duffy, the transportation secretary, essentially saying a couple weeks ago, we're going after it. The governor of New York saying, no, you're not. It's the state fighting the federal government. Does that concern you?
I think that, you know, everybody who has sort of witnessed and experienced some of the transactional tone that Trump has is a tit for tat. That can be concerning. But I also believe that, look, I don't like congestion. I don't like that tax. It's costing me $3,000 a year to go to work. But if it's for the good of the people in general, then I'm grateful that I can pay for it.
Louise, one thing I want to ask you.
I'm going to tell you about the subway when we're off air.
Oh, okay. All right.
We can talk about using,
All right.
It's okay.
I do use it a lot.
Okay.
I do use it a lot.
I want to ask
It is
you.
my mobile office.
Okay.
There's policy, there's also rate environment. And mortgage rates in the U.S. dropped for a sixth week.
Hey,
Week.
6.4 today, right?
Right, falling to the lowest level in more than 2 months. Yeah, exactly. So I love it. You knew it, right on it. And that's one of the things we've been talking, just looking at the U.S. Treasury curve. It's a trade. But are you seeing, our story last week said, as they've seen mortgage rates go down, that you're starting to see supply increase because people are now willing to maybe let go? And maybe, so are you seeing any signs of that?
Absolutely. I mean, I've had more bidding wars. I've been outbid more in the last 2 months. I mean, listen,
But people are willing to start to let go of homes because...
Yes. And what they wouldn't do then, they will do now. And each of those, some of them have personal circumstances, but I think it's also an attitude and a tone, like how long are you going to wait?
Yeah.
And what are the policies that are being implemented now going to be in 6 months? We know it usually takes 6 months to see it in the real estate transactions.
Right.
Right? That cause and effect, unlike the stock market today. So I think that what's right for one person might not be right for another person, but we are absolutely seeing a attitude shift for, I would say, the smart, bigger picture people.
So two things, people willing to buy because they're comfortable where the rate is, and people who are in a home who've maybe had a low mortgage willing to let go? Or are we not seeing that yet?
I think the low mortgage thing is not a conversation as much as the next chapter of their life is a conversation.
Okay.
They're not letting go because there's nothing else to get.
Yeah.
So if you're going to, I don't know, Colorado, wherever there's some inventory that's not 32 people bidding on one unit, then you might let go of your place in Darien, Connecticut that has like 17 homes on the market,
Yeah.
So I think that those are things that we're up against. I'll also just say that interesting, the second week in February, they did 41 transactions in 1 week north of 4 million. And that is the most activity that we have seen in that sector since 2022, since March of 2022.
Where's weakness in the market? What price point?
Priced incorrectly, homes that are priced incorrectly.
Mean too high or too low?
Look, the low, I mean, every sector is moving if it's priced right. So, I mean, that's why we have 104 units that are in contract for north of 10 million. I bet if I was to really do the analysis that those are all had multiple price reductions.
Nothing in here says recession to you? Just quickly, just got about 25 seconds.
Not
You hesitated.
No, I'm just trying to be thoughtful.
Okay.
I feel that people have been just through. People can date their rate and marry their home and refinance, and I think that's a lot of the attitude for people, and that's why you have parents more willing to take their inheritance and let them experience it, use it, have it, than waiting for them to pass away.
I hear that from a lot of families. Nice to check in with you.
Thank you.
Thank you. Louise Phillips Forbes, real estate broker at Brown Harris Stevens, joining us once again right here in our New York studio. Folks, you are listening and watching Bloomberg Business Week.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. S&P 500 index had its worst sell-off of 2025 as bonds climbed. More tepid economic news and a pledge by President Trump to push through tariffs on top trading partners stressed Wall Street risk tolerances anew. Right to the numbers, with the S&P today dropping by 105 points. That was a decline of 1.8%. The Dow was down 649, a drop of 1.5%. Nasdaq down 497, a drop of 2.6%. The 10-year, 4.15%. The 2-year, 3.95%. Gold surged $35 the ounce, up 1.2%, now at $28.93. West Texas Intermediate crude down 1.9%, $68.42 on a barrel of WTI. And Bitcoin now down 8.4%, 86,378 on Bitcoin. So what about individual investor reaction to today's selling and tariffs? Alexis Brown Roberts is COO at Alexis Investment Partners. And right here on Bloomberg Business Week, she told us there is an even split.
Half of my clients are ecstatic with what's going on and think this is great for the country and great for their wallets. And the other half of my clients are looking at things going, oh, dear Lord, what's happening? And very negative on things. So, yeah, I definitely have clients on both ends of the spectrum there.
Alexis Brown Roberts of Alexis Investment Partners. Again, the S&P down 105 today, down by 1.8%. 10-year, worth repeating, 4.15%, with a 2-year, 3.95%. And Bitcoin, again, down 8.4%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thanks so much for that update, Charlie Pellet. Really do appreciate it. Hey, worth just reminding everybody, I know Charlie just did, but where things finished on a day like today, I look at a company such as NVIDIA, which really dragged down the S&P 500 and the NASDAQ, falling today, Carol, and pulling the indices down with them, 8.7% to the downside today, going back to levels last seen since September.
Just pulled up the Bloomberg Mag 7 total return index, down 3% today. So we did see, but I mean, fairly broad-based selling. Most names in the S&P were lower, but not everything headed for the exit door. In the meantime, we kind of want to stay on real estate for a moment. Just had a really interesting conversation with our last guest.
You don't have to market to market, which is nice, you know.
Not yet.
Every day.
Not every day.
Maybe when it's on the blockchain, it'll have like daily values. But
there was a piece of data that came out that kind of struck us. U.S. Census Bureau data on office construction spending rose 0.4% from last month. Why might you care? This data generally refers to the value of new construction activity of office properties on a seasonally adjusted basis. So rising construction spending suggests increased amount of new supply to come, which presents a challenge for landlords tasked with leasing new and existing space. So this we thought might be a good setup for our next guest. We're going to continue talking real estate.
He's a commercial and office investor and developer. Back with us is Michael Chavot, founder, chairman, and CEO of the luxury real estate company that bears his name. It's got a current portfolio valued at about $8 billion. It includes properties in New York, San Francisco, Miami Beach, and Chicago. He joins us from New York City. Michael, it's been a while since we spoke. How are you?
I'm great. How are you guys doing?
We're doing pretty well. Look, can't ignore the market on a day like today, the equity market. Does a sell-off such as this make you nervous at all?
I just heard what you guys said. You know, we don't have to mark the market every day. So whatever happens in the market is really doesn't concern us. Real estate, and particularly commercial real estate, are long-term investments. You know, we buy trophy assets. We're going to own them for 20 to 30 years. The bumps in the road obviously are unpleasant, but they don't really affect the market, obviously, like the equity market or any other markets that are so sensitive to the daily activities.
No, but a market decline or pullback, or if it's representative of things to come, an indication of maybe the U.S. economy softening, earnings maybe not being as robust, it will or could lead to companies saying, I'm not going to expand, I'm not going to take that office space, or I'm not going to do this, or I'm not going to do that new building, that new office building or headquarters. So tell us what's been kind of the mood, the environment when it comes to movement, demand, and new build that you're seeing in the commercial office space right now.
Sure. I think that when you look at companies, actually, since the election, we've seen a huge spike in office demand. We could talk about the San Francisco market. You know, we spoke about this multiple times. I've been on your show. And every time it's the same question, what's going to happen in San Francisco? 2 years ago, I came to the show, I said San Francisco is going to be great when everybody thought it's going to get demised. And today, San Francisco, last quarter, has seen the highest level of leasing since COVID. So we're seeing a huge return in San Francisco as a market as a whole. We're seeing heightened tours. We're seeing companies expand space in San Francisco, which is something we haven't seen since before COVID. I think there's an absolute positive mood in the market. Again, you're talking about, there's obviously the unknowns with the tariffs and things that change the market on a daily basis, but companies are making longer term plans. We're seeing large companies now engaging again to make commitments, if it's law firms, if it's banks. Obviously, the AI industry in San Francisco is booming. So we're quite positive. I mean, we've done, at the Pyramid alone, we've done 250,000 square feet of leasing over the last 7 weeks. It's the most leasing we've done over the last 18 months. So we're seeing the reality of kind of what we call the Trump election, and we'll have to see how long this lasts. But as of now, things are, at least on the leasing side, extremely positive.
You know, I was thinking of you when I saw this story today hit at noon, because I knew we were speaking to you about San Francisco, but Anthropic has raised $3.5 billion at a valuation of $61.5 billion. The amount of money that we've seen go into these AI companies, OpenAI, it's currently in talks for an even larger $300 billion valuation. How are you seeing that money ripple throughout San Francisco commercial real estate?
So in 2024, there were approximately 86 new AI leases that were signed, right? And those leases, some beyond OpenAI, a lot of them are startups or kind of a little bit later stage companies. Those leases beyond the large leases were, 10 to 25,000 square foot leases. Q1 of this year, we're seeing AI companies go to 50 to 100,000 square foot spaces, which is a huge shift, right? It means that there's larger commitment, larger space, but it really means that companies are getting larger investments because a lot of these companies are not profitable. So we're seeing a very fast growth in the AI business that's driving them to take more space. And San Francisco is obviously the hub of AI. So we feel very positive about the AI industry. It's been booming. It's been growing, I think, at the fastest industry we've ever seen of a single industry that's driving the real estate markets.
Michael, at what price are people taking new space? Is it at a discount to where it was pre-pandemic?
So it depends what type of space, right? Okay. So again, there's kind of the trophy space, like the Trans-America Pyramid, and there is the commodity. So the commodity space is trading at a discount, and at a big discount. I would say 30 to 40% discount than what it was pre-COVID, because there's a tremendous amount of inventory. And I think I told you last time I was on that a lot of these buildings, in my opinion, should just be demolished because they expired. But the trophy assets, if it's the Trans-America Pyramid in San Francisco or some of the other assets that we're handling, are seeing record rents. I mean, we've done rents at the Trans-America Pyramid today that are 3 times the rent of pre-COVID, because companies at the top of the market are continuing to spend, are seeing growth, and are willing to spend a lot more money on rent, because over the last 20 years, the company's growth has been a lot faster than rent growth. Rent growth normally is 3% a year. Companies have grown, obviously, if you look at the market, at a much faster pace.
Yeah.
So a little bit of a catch-up now is what companies are paying on rent versus their NOI, or versus kind of their income.
Hey, while we have you, I want to talk about LA. You've got the property, the Mandarin Oriental Residences in Beverly Hills. Climate change, the devastating LA fires from a few weeks ago impacting the market. How is that happening? How is it impacting construction that's being done in the area? Just 30 seconds.
So look, LA has suffered a huge blow. Interestingly enough, it did for a property that's available, it actually spiked demand because people need place to live. There's a shortage now of housing in LA. So it's an unfortunate thing, but there is right now a shortage of housing because there hasn't been real development in LA over the last 20 years, like anything of real substance.
All right. Going to leave it on that note. Wish we had more time, but look forward to next time. Michael, thank you so much. Michael Chavot, he's founder, chairman, and CEO of the luxury real estate company Chavot, joining us with another view, if you will, on real estate, this time really the office property area. And we know they've been in San Francisco, couple of West Coast, Miami, Florida, so good view on that.
Hey, reminder, the S&P 500 fell today by 1.8%, the NASDAQ down 2.7%, the Dow today by 1.5% to the downside. We're going to have more on the markets when we come back. This is Bloomberg Business Week.